So the outline of the video that we're going to be going over, what makes a trend line? Identifying a trend, this is really important, even if you're not using technical analysis. If you're a fundamental investor, you need to know if the overall trend of the stock that you're looking at is going up or down, as that's greatly going to depend on whether or not you make profit. There's two schools of thought. Some people use the upper wicks of the candlesticks or the lower wicks, and some people use the real bodies. Personally, I use the real bodies, and neither is right or wrong. It's important that you remain consistent, and inconsistency obviously will give you some wrong signals. So we'll look at some examples of the two schools of thought as well as inconsistent trend lines. And then last and most important, what do trend lines tell us? How can we utilize this information to make more profitable trades and investments? They're going to tell us potential reversals, breakouts, and then all these patterns, flags, pennants, channels, triangles, they are all dependent on being able to draw accurate trend lines, and then being able to see clear patterns breaking out or forming are going to give us one step up on the herd, so to speak, which are not utilizing technical analysis and seeing all of this price action visually in front of us. So what makes a trend line? The prevailing direction of a trend is composed of either higher lows on an uptrend or lower highs on a downtrend. Seems like a pretty fundamental basic concept. We'll look at some examples of that. But in terms of the trend line, you obviously need at least 2 points to be able to draw a trend line. But that's not enough in terms of having a valid trend line. 3 touches is the bare minimum needed for it to be valid. Doesn't mean you can't draw a trend line with only 2 touches, but that just means you don't put too much weight into it being an accurate trend line until you get that 3rd touch. And the more touches you get, the more valid the trend line is and the more confident you can be. If you have a trend line that has played out over the past 2 years and it's touched that trend line 15 times, you know that the odds are more likely than not that the next time it comes down to that trend line, it will likely hold it again, just like it has done many times in the past. So let's get into some examples. This is a very visually dependent topic, so we're going to go over all kinds of examples of everything we just talked about. So this is gold on the hourly time frame, and we're going to be looking at what constitutes a downtrend, and it's the lower lows. Lower highs and lower lows. So there doesn't always have to be lower lows, and we'll look at a couple examples. A descending triangle pattern has a horizontal base and then lower highs as the price gets tighter and tighter. So we'll look at those examples, but lower highs and lower lows is the basic fundamental of what a downtrend is. And just think of stairs. If you're going upstairs, higher lows, higher highs, and downstairs is the opposite, lower highs and lower lows. So drawing a trend line, this is me using real bodies. So I'm picking a point to start that trend line at, and picking your point really becomes with practice, because if I were to start this trend line up back here, it would not be a good trend line because I would only be able to hit 1 point. So let's do some examples here. If I were to draw the trend line from, let's say, the highest price that was hit here, I would use that real body of the candlestick and I would get that one trend line. And when I'm drawing trend lines with the real body of the candlestick, I'm ensuring that no candlestick is closing above my downtrend line. So you can see this candlestick is poking out above it, but the close of that red candlestick is all the way down here. I'm making sure that the green candlestick closed right at my resistance line and then the price rejected. So I wouldn't want to draw my trend line here just because it hits twice and then the price action is all the way down there. I want to be where the action is at. So I would choose this as my starting point, that top on that bounce attempt, and then I would make sure to hit as many points as I can on the way down. But again, I'm just getting tighter and tighter and making sure that no price closes above my downtrend line. So if I were to pull it in and hit this point right here and make my focus right there, then I'm seeing that this breakout occurs, and this would make it an invalid trend line because obviously the price is not responding to it. So I want to give a little bit more wiggle room, and again, make sure that no hourly candlesticks are closing above my downtrend line. I'm closing right on it, right below it, and then there's that rejection. So I've got 1, 2, 3, 4 touches, and then it ended up touching a 5th time down here, and actually a 6th time right there before that clear break above it, and that is telling us that the bulls are showing up. So every time we rejected, another lower low followed through with it. Now that we have broken this downtrend line, that could be a bullish entry signal because we are seeing that the price is no longer rejecting from that level. Now, personally, not only is the break of a trend line important, I use trend lines as sort of a heads up. It's not all out in the bag for the bulls once that level breaks, because I'm I'm all about price action. Price action is king in my opinion. So I'll be looking at these lower highs that are set, and these are forming resistance. Every time we make a bounce attempt and reject, that's a new resistance level to be watching. So we made a bounce and we rejected from 1202. We made another bounce, rejected from 1191, and then another bounce, the last one here before the breakout, rejected at 1186. So now that the bulls have gotten in control, that alone, breaking that trend line, could be a buy signal for the more risky traders. If someone wanted to be a bit more cautious, they would wait for the lower high pattern to break as well. So again, this top was at 1191. So once the price breaks 1191, we break the lower high pattern. So not only is the trend line important, but so is the previous price action. And because that's where we're going to be looking for resistance now that we're on our way back up again. So we can even draw an uptrend line here. When I'm drawing an uptrend line, I'm hitting the bottom of any red candlestick. I'm making sure no hourly candlestick closes below my uptrend line. So even though this green candlestick is dipping well below that trend line, that's the open of the candlestick, that's the close of the candlestick. Every single close here is above my trend line support. So where do we find resistance? We look back at the downtrend. Every bounce attempt rejected and formed a new resistance level. So I'm seeing a resistance level up here at 1202, and we are currently at 1194. So that is one of the next levels that I would be looking at. There was another little bounce attempt right here that rejected from the downtrend line. That level is 1198, so that's going to come first. So that's a clear downtrend line. Let's look at Tesla on the daily time frame. Very strong uptrend. So again, making sure no candlestick is closing below. We have plenty of lower wicks dipping below, but as long as the price continues to close above that level, it acts as support. So here we are. Visually, I zoom out and say, where do I want to start my trend? I want to start the uptrend line. Once we have our clear lowest price, and we had a little higher low here. So we can see once that steep trend started, right down at the base is where I choose that first candlestick to go off of, and then we touch that level, or we touch this trend line 1, 2, 3, 4 more times than you can count here. Well, I would hope you can count that high, but let's call it a dozen plus times, so we know that's a very valid trend line, and it keeps hitting it and bouncing. We're consolidating now where we currently stand, and we have this trend line support to be watching, and we can utilize this information because if we lose this uptrend line, that's a potential signal to reverse and look in the opposite direction. So like I said earlier in the outline, losing an uptrend line or breaking a downtrend line is a signal of a potential reversal and can have us looking in the other direction. So let's look back at those same trend lines we were just looking at, and let's go over the two different schools of thought. And again, neither is right or wrong. It all depends on what resonates with you personally. So if we have someone who is prescribing to the upper wicks theory on a downtrend, we would be looking at someone drawing their start at the upper wick and hitting the upper wicks on the way down, making sure no upper wick is poking above their downtrend resistance line. So that is where that trend would go. And personally, why I don't like this is because technical analysis is not an exact science. So breaking the downtrend line would be just poking above it. And we can see here this candle right before the bounce started broke above it and then pulled back fairly significantly. So that's a little bit of a fake out. And fake outs obviously happen. Like I said, it's not an exact science. But I like the real bodies of the candlestick because that makes the bulls in this scenario prove to me that they have the strength to not only break above, but to close the candlestick above that downtrend resistance line. So a bullish push and then the bears stepping back in and knocking the price down wouldn't occur because we would have to be sure that the close was going to come over the downtrend line. So with this school of thought, you might get a signal a little bit earlier, and potentially some of the times that's going to work out and give you greater profit. But with greater reward is going to come greater risk with the scenario that potentially the price gets rejected and doesn't close above that downtrend line. So again, that's the upper wick. And personally, I'm using the real bodies and making sure that the price has to close above the downtrend resistance line in order for it to be broken. So same thing on Tesla. Let's see where we would draw this trend line. If we were using the wicks, it would be a lot more wiggle room because of that downtrend line or that down spike right here where that lower wick dipped. Let's zoom in so we can get this more clearly. So hitting and making sure that no lower wicks are dipping below the price. We've got multiple touches here. And again, that gives a lot more wiggle room. We could pull back multiple days before we touch this trend line. Whereas if I'm using the real bodies, it's a lot tighter and there's a lot less wiggle room. So in this scenario, we might get an earlier signal because I'm using the real bodies rather than the wicks, because there's a lot less wiggle room before we do touch that trend line. So again, there is no right or wrong answer. I suggest playing around with both, seeing which you like better. I'm not saying I'm right and everybody else is wrong that does it the other way, but this is just what has resonated with me over the years as what I find to be more accurate and a more strong signal at looking at a break of trends. Now, the important part about which school of thought we choose is remaining consistent, because we don't want to be using upper wicks on some parts of the trend line and real bodies on the other. So if I'm starting at the real body here, let's draw this downtrend line, and then I'm hitting the wick of this next line right here, that's not going to be as accurate because I'm starting with the real bodies and then I'm changing to hit the wicks. So I want to remain consistent. If I'm using real bodies, use them the whole way down. A lot of times you'll see biased traders or investors, and they love to be all over StockTwits and all these forums where they will shape their trend lines to fit their bias. And if you remain consistent, you can help eliminate that bias, because if someone's saying there's going to be a bullish break and they're going to draw their trend line to hit the real body and then the wick and then show that a break has occurred sooner than it would if they had remained consistent with their style of thought. So let's say if they were starting with the upper wick back here, they would have to hit this upper wick all the way up here, which would be a much softer trend line, softer meaning not as steep, and it would take a lot longer to make a bullish break. Now, let's say someone wants to be bullish because they already entered their bullish position. They would drop it down and hit the real body of the candlestick and say, oh, we already had our breakout, the bulls are in control. But if you're hitting the wicks and then you switch to start hitting real bodies, that's not consistent, and that's just a biased confirmation that you're seeing what you want to see. So remaining consistent helps eliminate bias. Now we're going to get into patterns, because very, very many patterns are reliant on being able to draw accurate trend lines. So when I look at Tesla here on the hourly time frame, I can see we're very clearly in a higher low, higher high bullish uptrend. And when I look at it on the daily time frame, this is the hourly. So on the daily, I can see what stands out to me as multiple bull flags. And a bull flag occurs when you have a steep breakout and then normal healthy consolidation for a brief period of time before continuation to the upside. And you can see the consolidation for a couple days. So just looking on the daily time frame, I can recognize that that is the pattern, but I can zoom in on the hourly time frame and draw it a bit more accurately. So let's look at this potential bull flag. And a bull flag is also a channel. What makes it a bull flag is that it is occurring after a breakout has occurred. So here I am drawing my downtrend resistance line, and I'm making sure that no candlesticks are closing above this downtrend line. Candlesticks can break above it, that's fine, but it's touching multiple times, a bunch of times here. Another rejection, so I'm seeing the start and another one, second, third, fourth, and then before a bullish break. And you can actually get some confirmation a lot of times that your trend line is accurate if after a bull break, the price back tests and holds that level. And if I were to draw it exactly tight there, that's where it would be. And you can see, let me draw the whole bull flag first. We need that bottom channel as well. So on the channel, I'm hitting the low of the initial consolidation. I'm making sure no candlestick closes below it. And then we can see the price reject and then bounce and reject and bounce, all the while normal healthy consolidation because it's following this big time breakout. And you can see once the breakout did occur, it back tested and held that previous resistance line as support. So not only do I get the confidence that we have a clear parallel channel, which represents the bull flag, a breakout, and then a pullback and a bounce off that level and an explosion to the upside, confirming. Another pattern I can draw back here, this looks like a bull flag, so I want to zoom in and get more detail on the hourly. I've got my downtrend resistance line to draw, hitting the upper body of that green candlestick, no candlesticks closing above it until the breakout. And then when I go and draw my downtrend line, I say, oh, this isn't parallel, so that's not a bull flag. And it took zooming in to be able to see that, because we'll zoom out again and look on the daily. Daily looks like a bull flag. But here, I would draw my trend line right there to make sure no candlesticks are closing below. We had a lower wick bounce right off of it, a couple more touches, and then a breakout. This is a descending wedge pattern, and the difference is a parallel channel with an even space in between. as opposed to a tightening range that eventually leads to a clear break. And if we zoom out on the daily time frame, we don't get that detail. We get the multiple days of consolidation with lower wicks, bulls buying the dip, and then continuation. Here, very similar. 3 days of pullback, bulls buying the lower dips. And it takes zooming into the hourly time frame to see the difference in those two patterns. Another pattern we're going to look at is bear flags. This is gold on the 4-hour chart. So I just did those bull flags, and this is the opposite. It comes after a dump. It's a weak bounce attempt, and it leads to continuation to the downside. So I can see the stair-step pattern, lower highs and lower lows. So I draw. Let's actually zoom in here a little bit more so we can see more clearly. I would hit the upper real bodies of these candlesticks, and then the lows of the red bodies, making sure no red bodies close below. And again, obviously all of these patterns are drawn in hindsight, as I wanted to get some good examples. But if this bounce were playing out, I would draw these channels and wait for the clear break. And same thing, we had a clear bear break, and then the bulls attempted to get back over, couldn't do it, and then a dump. And then we had another bear flag down here, parallel channel hitting the real bodies of the candlesticks, making sure no red candlesticks close below. And that bear break occurred right here on this candlestick and then led to a dump. So these patterns are all about drawing trend lines on different time frames, being able to recognize the price action, constricting ranges leading to downside. So recognizing patterns is obviously important, but being able to draw the trend lines that allow you to recognize the patterns just as equally as important. Let's look at a couple more here. We're going to look at a pennant and a triangle. Here we have the biotech sector on the weekly time frame. So as you can tell, these patterns are all different time frames all over the place. And on the weekly time frame, just visually, what stands out to me here is a tightening pattern where we have a clear higher low pattern. So I know that the bulls are in a nice uptrend. But I see that recently we also have a lower high pattern starting as well. So we're in an uptrend, but we're seeing some lower highs. And I would draw things to see a bit more clearly what's going on. So originally we had a nice strong uptrend line here, but that had broken. So wouldn't want to draw it from there just because the price had gotten below that level. So I would draw it a little bit closer. And we've got 1, 2, there's our third touch. So I'm hitting the real body down here on that big drop that broke that other trend line I just drew. We're hitting it again and then hitting it a third time. And I can see this clear lower high pattern. So again, I might be playing around. Draw as much as you want, and you can always adjust things. So if I were to draw a trend line here, that's a valid trend line. Hitting it multiple times. I'm hitting this lower high back here 2, 3 times. You can see the tightening range very clearly. But I can make it even tighter by using the more recent price action and using this recent high, highest price we saw on the bounce, using that real body of the candlestick and drawing it right there. So this is going to give me a breakout sooner. And let's just compare it to that other trend line again. We would have, again, a valid trend line, but it wouldn't give us we have all this space here. This one that I just drew is tighter and is going to give us a signal sooner. So we bounced off it 3 times. We rejected from it 3 times. This is a very important pattern that's going to break in the next 3 weeks. And that's the other thing that these trend lines and these patterns can give you. They can give you time frame. I know that this pattern is going to break in 3 weeks at the latest, because there's really just not going to physically be space for the price to remain in this tight channel once these candlesticks begin forming for the next couple of weeks. So a break of this channel or this pennant here in one direction or the other, it's not a channel, it's a pennant with tightening ranges. It's going to give us short-term direction, whether to be looking bullish and up at these resistance levels. Again, the lower highs act as resistance, or if it's a bear break, the higher lows are going to act as support, those levels that we bounced off of. So this is a really nice pattern that we're all going to be watching here over the next month on XBI on the weekly time frame. Another pattern on NKE, Nike, the daily. Again, very clear higher low pattern. I can tell we are recently in an uptrend following a downtrend. So let's just, you can tell you could spend 10 hours drawing all these trend lines. Certainly plenty to be practicing with. There's a trend line here where we made a bull break. So again, no candlestick here is closing on the daily chart above my downtrend line. And you can see how quickly I was just able to throw that up there, visually speaking. And we made a bull break, but we're still dropping. Uh-oh, that trend line must be invalid. Look exactly where we bounced off of. the previous resistance acting as support, and then the trend changed. So now we can see an uptrend, but I see the price is struggling here. I'm looking at the closes of these candlesticks, and I'm seeing that these bulls are having a tough time closing over the $54 psychological resistance level. So I throw my resistance line right there. I can see 1, 2, a couple rejections just below it, 3, 4, 5 rejections from it, but I still see those higher low patterns. So we are in an uptrend, but we have a horizontal resistance line, and this is a ascending triangle pattern. And I would draw a trend line here and say, nope, that's way too tight. Can't start it from that point. So play around with your starting and end points. I would start it from this candlestick, and I would put it right there, making sure Friday didn't close below it. We're touching it 1, 2, 3, 4 times. Range is getting tighter. Same thing. I know there's going to be a break sometime within the next 5 to 6 trading days. If we close below the uptrend line, we're going to look at all these previous higher lows as support levels. And if we close above $54, it's going to be a clear bull break. So this is an ascending triangle pattern going off of the uptrend line and a horizontal resistance line. So you can find these patterns and these trend lines all over the place, and they are really going to open things up for you visually. If you are newer to charts and you're looking at charts and it's just a whole bunch of candlesticks and a bit cluttered, once you start drawing and practicing and playing around, things become a lot more clear, and you'll be able to recognize these patterns just by seeing where the line that you would draw. Like, for example, when we just looked at this and I made that pretend start and I saw that that line wasn't going to fit, I could just visually know that that wasn't going to be a valid trend line just because of practice and experience doing it. I would know that I need to start it right up there. So if it's taking you a long time to draw these trend lines at the start, don't let that discourage you, because like I said, it's riding a bike. And the more you do this, the more it's just going to snap visually for you. And if you're a visual learner, trend lines are certainly for you. So I appreciate you watching this video. If you have any questions, feel free to ask them. Hopefully this was eye-opening to some degree. And again, it's all about practicing from here. Pull up charts, look at all different kinds of trend lines, draw those trend lines, and then keep an eye on them once the price action resumes and see what the clear break is. For XBI, we're going to be watching this one very closely over the next few weeks in our chat room, and we're going to play the signal whichever it gives us in that direction. So thanks again. Hope you have a great night or day whenever you're watching it. See you soon.